Hi everyone, welcome to today's video. So on today's video, we are going to have a discussion on what type of monopoly stocks you should be buying and what type of monopoly stocks you should be avoiding. Super important video for the simple fact that right now the markets are somewhat lukewarm. There are great buying opportunities, and usually when you are a new retail investor, your intent is that, hey, let me Google what monopoly stocks in India are. You will get this list and you will go and invest your money in these type of companies. And in many of these companies, you will end up making permanent loss. So please watch this video, make notes, super important video from that perspective. I will present a very easy to understand analysis of monopoly companies. But before I jump into the core of the video, I want you to take a look at this particular chart of Coal India. This is one of the monopoly companies, and what you will find is this, that back in 2010, the stock was trading at roughly 350 rupees. Right now, the stock is trading at 180 rupees. And the worst part is that honestly, it did not go up much in any of these phases. But again, here is the list of monopoly stock companies for you in India. You will see Coal India as being one of the monopoly stocks. Story number 2, take a look at the chart for Nestle. So this stock has consistently given an upward trending curve. So if you would have invested in this monopoly company, you would have made money, no doubt about that. Now let's take example number 3 of ITC. Now ITC for the last 10 years, it has been trading at that 220 levels and it has gone up, it has come down, it has gone up, and it is literally trading sideways. That is what is happening with ITC stock. So all three monopolies, but all three are presenting very, very different stories. So what type of monopoly companies to invest in versus what type of monopoly companies you should avoid? Let's quickly discuss that. So there are 5 key reasons why you should be avoiding certain monopoly stocks. So let me walk you through this list one by one. So the first reason is that if it's a PSU company and if it is trading at a slightly higher price or even at an average price, you should avoid buying it. Why? I will explain that in a minute. Second, if the company has limited growth potential or limited growth prospects, please avoid it. There is no point in buying that. 3, if the company has unclear growth prospects, then you could consider avoiding that company. 4th, if the nature of the business is cyclical, that some years it goes up, some year it goes down, avoid it. 5th and final point, if the government intervention in that sector is high or is going to become high, avoid that sector altogether. So these are 5 specific reasons. Let me go point by point and it will give you very good clarity. So let us first and foremost understand why you should not be purchasing too many PSU stocks to begin with. A classic case in point is the IRCTC case study. Everyone thinks, almost all the retail investors think that, you know what, IRCTC is a great stock. When I ask them why, because it's a monopoly stock and it has given so much run up. Okay, so let me talk about 2-3 very quick points. Let me show you the investor holding in IRCTC. So you will clearly see that the investor holding of FIIs is coming down, even DIIs is coming down. Only public's investing is going up. Why? Because we are so attached to railways, we see it as a monopoly stock. We think that, you know what, something like IRCTC will forever go up in profits. Its revenues are going to break all the records. Indian railways will enter Japan also. Indian railways will enter China also. Everywhere it will enter and we will become super filthy rich. Incorrect perspective, and I will tell you systematically why. There are 2 prominent reasons. First and foremost, the PSU companies are run with the intent of serving the nation, so to say, or serving the politicians. I don't know. You comment and tell me below. That is the first key reason. They are not even trying to make sustained profit. This is the same problem that Coal India also had. This is the same problem that IRCTC is also having, and this is the same problem that even PSU banks also have. That despite having massive competitive advantage, their focus is not profit making. For example, let's understand by using a banking example, what is the objective of PSU banks? The objective of PSU bank is network extension. So they go all across the nation, they build more branches. Even if that branch is running unprofitably, the PSU banks will continue to run these branches simply because they want to give accessibility. Now this is a noble aim. I'm not trying to comment on the social aspect of it. I'm just telling you from a pure profit making perspective that this is probably not a good move. Now this was a similar problem even in the airlines industry. A classic case in point is the Air India story. Now, Air India ran a lot of unprofitable routes simply because it wanted to give access to a lot of people who did not have access to airlines. For example, they would run certain routes and fill 30 out of 100 seats. Why? Because they are improving accessibility. They are not there to optimize the profits per se. There is an entire political story also that I can tell you here, but I will avoid telling it. But I hope you get the picture that PSU organizations are not run with the intent of making money to begin with. Second key problem that PSU enterprises have, that in case there is an entity which is profit making, then politicians figure out a way to siphon profits off. So the word of the day today is siphon. Let me know what does that mean. So the politicians simply siphon the money off. A classic case in point again is IRCTC. Now, here is an announcement that was made somewhere on October 28th, 29th, and the headline reads that IRCTC shares sharply recovers after government scrapes order on 50% convenience fee revenue sharing. So if you actually go and read this article, what happened on October 29th last year, and I had made a video also on that in a curious policy flip-flop, the Ministry of Railway on Friday reversed a decision taken less than 24 hours earlier, in which it had asked IRCTC to share with it half the revenues collected as convenience fee from users. So the moment this announcement came in, the IRCTC stock fell a lot. Now, because Ministry of Railways will start taking your profits, so the stock price fell, and next day it was announced that no, we are not going to do that. Just relax. Then the stock prices came back up. But the important point from this narrative is fairly simple, that with just one move, the entire company's market cap can dramatically change. So it's always risky to invest in PSU stocks unless you are getting them at very, very good prices. Now, the second key reason to avoid some monopoly stock is that if the growth prospects are very, very limited. A classic case in point is the BHEL stock. Again, take a look at this list of monopolies in India. BHEL features into it. And what BHEL simply does is that it's an integrated power plant equipment manufacturer engaged in designing, engineering, manufacture, erection, all this stuff for power transmission industry, that. It is a flagship engineering and manufacturing company of India, owned and controlled by the government of India. So that is what BHEL does. Now, let us take a look at the profit and loss statement, and what you will see is that the sales have hardly grown. In 2010, sales were 33,500. Now it's standing at 20,000, and it has barely moved above 33 in maybe 2-3 years. That's it. So it has been a very slow sales growth company. Now ask yourself, why is that the case? So it's very simple and it's very mathematically driven. So what are profits? So profits are revenues minus cost, right? Everyone would have understood and used this formula at some stage in our life. So what are revenues? Revenues are price times the quantity. So what happens with companies like BHEL, that every ad hoc basis, they will keep on winning some contracts so as to get certain businesses. But does the management of BHEL has any incentive to increase this quantity or the number of contracts that they are winning? The answer is no, they don't care. Basically, you have other companies which are private companies. They will push really hard. They will probably give bribes also. They will do 100 different things to increase this queue, right? There is just no point, right? Second key thing about the prices. Now, again, I don't need to go at the back end. It's very given that at the back end, there is a lot of shady stuff that goes into pricing of any particular thing. For example, if a PSU company is selling product X, I'm not talking in context of BHEL because I'll get sued. So this is not a comment on BHEL or any particular PSU. I'm just giving you a general case and you tell me whether this is right or not, right? So for example, if a PSU company is selling any product, let's call it X. If the price of that product is 100, then a private player would want to sell that at 120 rupees. But a PSU company would not bother at all. Sell it at 50. They don't care as long as they are making a little bit of commissions along the way. So the point is that there is no incentive to grow this revenue. This is very, very important. And also there is very limited scope of cutting cost. How? Think about it this way, that let's say tomorrow RPA technology or robotic process automation technology comes into the picture. Now, Indian Railways employs such a big workforce and there are obvious cost saving opportunities by rationalizing the workforce. Do you think that Indian Railways can take that step of firing people? They can't do it because there will be people sitting on dharna and bunch of other different things. Again, this is me just speaking and analyzing a business. I'm not here to give the social aspect of it. So from that particular perspective, whenever you find monopolies that has limited growth prospects, that they can't increase their business, they are not even interested in increasing their business, they don't have a lot of avenues in terms of cutting cost, please avoid it. That's a simple piece of advice that I'll give you. Point number 3, on certain occasions, depending on the type of an investor you are, you could consider avoiding companies where the growth prospects are not clear. There is a difference between point 2 and point 3. Point 2 is that the company does not have many avenues to grow in terms of increasing its revenues or bringing down the cost. Point number 3 is that there is no clarity on growth. The classic case in point is the ITC story. For example, if you take a look at the ITC business, you will see that the sales of ITC has been consistently growing. It's not as if that there was any kind of sales problem. It's not as if that there is any kind of profit problem. It's a net profitable company. But why is it that the ITC stock does not move? The reason there is fairly simple, that hey, the clarity on the most profitable part of ITC's business is not there, which is what? Which is that ITC sells a lot of cigarettes, and every time the budget is announced, people start fretting. People start believing that, you know what, ITC stock is going to go down because the government is going to impose more sin tax, this, that, and it becomes a problem for a company like ITC that despite doing everything in their hand, despite generating good results, despite having good management, despite performing well in the market, their stock price just does not go up. And one of the prime reasons is that business clarity is limited. Am I an investor in ITC? Yes, I am an investor in ITC. I'm still holding the stock. I am very happy with the dividends. It's a defense stock for me, and that is the reason why I'm holding it. But I do understand that business clarity with ITC is not really there. The moment the narrative for a company like ITC changes from that, hey, from a cigarette manufacturing business, we are pivoting to FMCG, and that is bringing us a lot of revenues, or our hotel business is bringing us a lot of revenues, ITC stock will become a rocket. So that's a simple point that you need to keep in mind. Point number 4, you must avoid cyclical businesses. The classic case in point is the Coal India story. So here, let me give you a very quick understanding of what Coal India does. So Coal India is mainly engaged in mining and production of coal, and also operates coal washeries. So basically, whenever the mining of the coal in India goes up, Coal India stock will go up. Whenever the mining of the coal in India goes down, Coal India stock will go down. That's a simple story. That is all it is. Now, do you know how much the Indian government is going to import coal next year? The answer is no. You don't know, and neither can we predict. And therefore, there is no point in getting into these cyclical businesses, because some year they can give a very good run up. Some year they will not give a run up. For many years, they will just move sideways, and it becomes a headache for you despite owning a monopoly stock. So that is a simple story. And can I prove it to you? Yes. For example, if you just simply Google coal imports in India, here it says the coal import is likely to be close to 180 to 190 metric ton in FY 2022. Now, these numbers can also go for a toss depending on the macroeconomic situations. For example, due to Russia-Ukraine crisis, lot of crisis in the energy sector. Now, if India will go and import more of coal. Who knows? They might not extract so much coal and direct Coal India to extract a lot of coal, because they just want to preserve their reserves given all this macroeconomic situation. Can you and I predict? No, we cannot predict how much coal is going to get extracted in India via Coal India, and there is just no point in getting into these type of stocks from that particular perspective. Now comes the fifth and the final point, that be on a lookout for sectors where the government intervention is going to be high, and please avoid those type of stocks and sectors. Let me give you a parallel example, not from the stock market, but from the education market. So back in 2009, government made an announcement that, you know what, if you run a private school unaided, which does not even get help from the government, they will have to reserve 25% of the seat for weaker economic sections of the society. Great move from a social perspective, but I can present an entire argument as to why many good schools, which were offering education at a low cost, if they have to go and reserve 25% of the seats on which they are not making much money, they had to close down, and that decreased the supply of education also in India. Now, of course, we can all present our own stories here, but the point that I'm trying to drive home here is fairly simple, that government intervenes quite excessively in a bunch of different businesses. So please try to avoid those businesses, because with one stroke of a pen, 25% profitability of any business can go down. Great news, if you invest in tech companies, then this type of situation is very difficult to play out. Why? Because government itself does not understand tech. If you don't trust me, go and look at the type of websites and the cyber cell infrastructure that they have. And that is the reason why technology companies have grown really fast, because by the time government understands anything, technology companies move on to the next level. So therefore, there is no point in investing in businesses where the government intervention is likely to be high. So a classic case in point here will be Hindustan Aeronautical Limited. It's a defense company. It produces a lot of defense related equipments, aircrafts, etc. I am not an investor in HAL from this simple fact. Okay, so before I walk into explaining which of these companies I will buy from this monopoly list, let me do a very quick commentary on what type of monopoly stocks you should be buying. So there are 3 specific criteria that you should keep in mind. Number 1, the firm should look to make profits. A classic case in point is Nestle. Now tell me how many different type of Maggies are there. Now Nestle is a market leader in the Maggi market, and it keeps on launching new brands after brands after brands of Maggi, that, you know, oats Maggi, Atta Maggi, this Maggi, green Maggi, pink Maggi, whatnot, right? So the bottom line is that Nestle is a company that is actually interested in making profit. It will go do market research. It will go study consumer buying patterns. It will go negotiate good deals with distributors. So all these things point to what? It simply points to the fact that Nestle actually is interested in making profit. And if it is a monopoly, then of course it can retain its position because it is working so hard to maintain its profit margins. So it's a definite investable company from that particular perspective. Number two, the company should have specific moat. A classic case in point is something like, let's say, Pidilite. Now, Pidilite has a product called as Fevicol. Now, do you remember the tagline of Fevicol? कि ये मजबूत जोड़ है टूटेगा नहीं. So that tagline in itself is recalled and remembered by crores and crores of people, and every time they go on a shop to buy any kind of adhesive, their preference would be to buy Fevicol. They will not even say कि हमें furniture जोड़ने वाली चीज दे दो. They will simply go and say Fevicol दे दो. Now, commanding that particular brand value is a massive moat or a competitive advantage for a monopoly that is not going to go away at least for the next 10 years. So it becomes an investable company. Now, third and finally, a monopoly of course will be big. You might be paying premium valuation. So you must remember that a monopoly also needs to have a very clear growth path. So I told you Pidilite and Nestle story. Now think about it this way. Now here is the press release of Nestle. So you'll see Nestle India launches Maggi Desh ke liye 2 minutes. So this is a brand campaign that they have launched. They have launched fight against COVID. They have launched like a bunch of different things. They have launched like #1 cola mint beverage Milo in India. They have launched Maggi fusion noodles. Okay, another variant of Maggi. So if you go through this entire list, you will quickly see that you know what? They are just exploring new paths to profitability. Why? Because they will be able to launch new products, sell it, make more money in the market. So they are on that product launch roadmap, and whenever the economy improves, they will continue to exhibit similar behavior. Similarly, talk about Pidilite story. They launched Fevicol first. Now they are getting into a bunch of other different products, and here is their product line. So the point is that they made Fevicol stand out. Now they are getting into a range of other products, and that will keep on generating a lot of money for them. So there is a very clear growth path to profitability. So now let's move on to the final section where I will just go through this list and talk about which stocks I will be buying in this market versus not. So IRCTC, I will not buy. I've explained the reason. HAL, I will not buy. Nestle, I will buy. Coal India, I will not buy. Hindustan Zinc, no, I will not buy. ITC, I already have, so I will not buy. Marico, I will definitely buy. Pidilite, I will buy. Concor, I will not buy. BHEL, I will not buy. So this is my point of view explained about monopoly stocks. Of course, you can have different arguments, different reasons for buying, what price you are buying, etc, etc. But I hope that this video helped you pick up a framework of analyzing these monopoly companies. So I hope you enjoyed the video. Please press the like button, and I will see you tomorrow.